All right. All right. Good evening. It is Saturday, August 31st, 2024, approximately 9:03 p.m. Eastern Standard Time. All right, I got one coming in hot for you. This shouldn't take too long to really explain, but I wanted to just give a quick look and a bit of an understanding from my experience perspective research on understanding fair value gaps and the role that they play in our trading setups, right? All over the internet, YouTube and different places that you look, everybody's kind of talking about fair value gaps and how to trade them and stuff, right? And in my opinion, nobody really talks about why fair value gaps are so significant. People do give somewhat of an interpretation. And again, even my interpretation is my interpretation based off of my experience in research. Again, keyword research, what I've really, found, to be somewhat valuable as far as information is concerned. Again, my interpretation of it. So I just wanted to share it. All right. So here we go. So let me share. So the first thing I'm going to do, yeah, I'm going to share my multi-time frame screen first, because that's going to give a good idea of the setups and what I'm looking at for next week for UJ. All right. So as most of the time, as you know, most of the time I'm using UJ for my trading and setups and stuff. All right. So this is my multi-time frame chart setup here and screen, to help me with my intraday top-down analysis. As you can see, so I did make a change. I know I change a lot. I took the volume on the bottom, I took that off, and I decided to just use volume candles. It just gave me a little bit more, it gave me some more space on my screen, to actually analyze the market. But these volume candles actually do the same thing. But it's a very good visual, obviously, what have you. So, all right, let's get into fair value gaps and the part that they play in trading and in our setup and process and stuff, right? So the thing to understand about fair value gaps is that, and I'm gonna show you, right? So as you can see here on the hourly, and typically I use the hourly for my analysis, my technical analysis time frame. It's where I gauge my trade setups from. I want to enter here and I want to exit here. Or what have you. And again, based off of the overall strength of the market that day. So if we're bullish, I'm looking to get in at a bullish. I'm looking to get in at a bullish uh, entry zone, zone of interest, right? So for here, as you can see, at the end of the day, Friday, price, started consolidating, right? And so my question was, well, why is price consolidating right here? Why does it keep stopping right here at this area? Well, what we don't see on the 1 hour, we can see on the 15-minute. See, that's why we have the analysis, we have the multi-time frame, and we do our analysis the way that we do, because what we can't see on one, we can see on the other. So the question was easily and quickly answered because we have this fair value gap that was created by the 12:15 candle, right? Now notice here, right, this is the 12 o'clock candle, and we see that that fair value gap was created at 12:15, and price basically has been bouncing off of it. It pretty much bounced off of it the rest of the day, and created this zone right here, which will probably end up being a resistance area, resistance zone when the market opens next week. We'll see, because of the consolidation that's right here. We'll see what ends up happening, but that probably end up being a resistance zone or something on the 1 hour. But again, as you can see, though, price stopped because of this fair value gap. Now, what is the significance into the significance of fair value gaps? So we know that this fair value gap, along with this one down here, were created based off of well, I'm not gonna say both of them, but I'm gonna use this one as an example because this is a really good example. So this fair value gap right here was created based off of news, right? And we know that what happens with fair value gaps is that price, pushes. So it creates an inefficiency or an imbalance. Um, an imbalance, a fair value gap can be an imbalance and inefficiency in the market, meaning that there was a lot of buy orders in this candle that were not filled. But the market was able to move up because there was so many buy orders placed along this price range. Remember, I was saying that in order for price to move in any one direction, there has to be at least one order, somebody willing to buy or sell in that direction at the next price point. So obviously here, there were quite a few people that were willing to buy right at the next price point because news came out and news, and this is what we call fundamentals. The fundamentals said that the dollar was strong, right? So because the fundamentals said that the dollar was strong, I'm willing to buy the dollar at whatever price point I need to buy it at just to get in, right? Just to get in there, right? But what ends up happening is a lot of those, because the transactions move so fast, remember, for every buy, you need a sell. For every sell, you need a buy. So what happens is a lot of the buy transactions within this candle did not go filled. That there was no transaction back and forth, but the market continued to move, right? So that's what creates the fair value gap. You have a lot of buy orders sitting here without the sell orders. So what happens is, again, price comes back to balance the market. And this is where you get your corrections from. You have impulse moves, and then you have corrective moves, right? Why do you have that? You have that because price creates that. It creates that, right? So I need to come back now and fill all of those buy orders, right? I need to fill all of those buy orders and correct the market. And that's why it's called inefficiency or an imbalance, because now the market is not balanced because we have a influx of buy orders that have not been filled by sell orders. So before the market can move any further, right, we need to fill this imbalance, right? Now, here is the somewhat insider info that I wanted to share to give you even more context about this, right? Well, most of this isn't retail traders that's sitting here pushing this market up like that, right? It's the banks, the hedge funds, the institutions that put these orders in along this entire candle here. They put those orders in knowing that they weren't going to be filled right away. They knew that because they know how the market works. And now I'm sharing this with you, right? So they know that I can push this market up, put my buy orders in here, right? Because the dollar is strong right now. And eventually my orders are going to be filled. And once my orders are filled, once we have sufficient sell orders, right? And this is what happens. See, we came down, pushed up a little bit, to create a little bit of liquidity. We pushed right back down, stopped some people out, stopped some folk out, right around here, created that liquidity. And then eventually we push back up. The strong push back up. Now that my buy orders were filled, right? Right. Now that my buy orders were filled, I can start pushing the market back up now and making money off of the dollar that I just bought, right? I bought a whole bunch of dollars and my orders got filled. And so now my dollar becomes even more valuable now because my orders are filled and now we're in the move, right? We knew that the dollar was going to be valuable in the near future because fundamentals said that it was. The economy is doing, somewhat good. So we're going to now make a lot of money off the dollars that we just bought in the creation of this fair value gap. And then what happens, right? So we run out of a bit of supply. So we have to orchestrate some supply because we ate up all the supply that was in this area. So we need more supply. So we need more sellers coming in to give us what we need to recalibrate and to continue we set some more buy orders probably and to continue to push the market forward, right? Again, strong push to the upside, right? And what do we have yet again? Another fair value gap, right? But we're okay with that. We're okay with that because we know at some point price is going to come back and fill those orders. fill my buy orders that I just put in, and we're going to continue to be off to the races. And that's exactly what's going to happen. So what we're looking for now that we start to understand what the market makers are doing, what the institutions are doing, we can follow suit. Just wait for them to make their move. We now wait for them to make their move. And here's what is likely to happen when the market opens after the holiday, right? What I'm looking to see, and I have my as you can see, I have my cursor here that kind of shows you on all four charts. How you get that is you go to your layout and you just click crosshairs, and it will have your crosshairs appear on each time frame on each chart at the same time. That's how that works. That way you can see when you're looking at levels and stuff, right? So I want to look at this fair value gap, and it's going to put my cursor because I want you to see it on the daily time frame what that looks like. So we want to pull back, right? So we want to see it, catch it on the daily, right? So we want price to come back and basically get into this gap. And what we're going to do is we're going to watch and see how price reacts to this gap, right? What we really want to see, because here's what happens a lot of times. Once price fully mitigates a fair value gap, it gives the market what it needs to go and create new highs or new lows. Again, indicative of what we saw right here with this fair value gap, right? Remember, price made the fair value gap, came back, filled the fair value gap, and created new highs, right? We want to see the same thing repeat itself when price comes into this fair value gap. Now, it may not come back and mitigate this entire fair value gap. That's why we want to see what price does when it gets to this fair value gap, and we watch that on our 15-minute because we'll drop down and get a better idea and understanding, because price very well could mitigate this 15-minute fair value gap, right? And then push down, grab that liquidity, until, we got a little gap right here, which all of that just amounts to this hourly fair value gap right here. That's what's really going on. So we want to see what happens. And again, price may not fully mitigate this fair value gap. We don't know. But again, we do know that once price makes its move, we get what we need. We fill enough orders, right, to push the market forward and create new highs. So what can potentially happen is price will come down, fill that fair value gap, right? However it does it, and then we look to target at the very least the highs. So here's how that can look. If price at the very least comes and let's say it half fills this fair value gap, right? Let's see what that looks like. So we're going to take our measurement tool, and let's say it comes down and fills about 50% of this fair value gap. What you do now is you target those highs, right? Once you get your entry signals, we're going to target the highs right there, right? We see the highs right there, right? So we're going to target those highs because we have sufficient liquidity to do so. So that's a 44, 45 pip move right there, right? That's at the very least. That's if it ends up mitigating half of that fair value gap. Now, if it mitigates the entire fair value gap, right? Let's say it mitigates the entire fair value gap, right? We get that 100%, right? Then once we get our entry signal, right? We go ahead and we target those same highs. Now you're looking at 50 plus pip move, right? Now you're looking at a 50 plus pip move. Now, here's what is bound to happen. Now, with that move, once we get those highs from the other day, which is going to be this high, right? The high today, right? We can look to target these highs, right? Because that's the closest liquidity. So we'll be able to target the liquidity sitting at these highs, this high, this high, this high, and possibly this high, right? So potentially, right? Let's look at what that can look like. Let's say, again, we get that full fair value gap or something like that, right? And we get in the move early enough. We don't want to get in too early, right? We can look at possibly getting a 250 pip move. A 250 pip move. That's what's possible. And we can break that down into increments based off how the market is moving day to day, or what have you. But again, just giving you an idea of what's possible and why it's possible, right? Now, the market could very well turn around and go bearish. I'm not going to say the only reason, but the more likelihood of it doing that will be because there's some type of news or something happening in the world fundamentally that now says the dollar is worth less than it was last week. That's how that works. As long as the dollar is more popular, right, and worth more than the yen fundamentally, then we're going to continue to buy, right? Because that worth, right, is me having dollars. My dollar now goes longer because it's popular, right? Same thing that happens with the yen. Now, what tends to happen is the yen, there may be some news or something come out. The Bank of Japan says that, the yen is going to do great and we're going to do great things. And now the yen is a bit popular, right? Then that creates a bit of consolidation. Now, what happens once we start to get that consolidation, because both the yen and the dollar are kind of doing the same thing, they're both equally as popular, right? We get that consolidation because neither one is making any headway over the other. Then what we wait for is that news or that fundamental catalyst, because it could be world events and things like that, that says that one is more popular than the other. That's where you get the breakouts, right? When prices consolidate, it's doing a couple of things, and it's doing it for a couple of reasons. But if it's consolidating based off of fundamentals, the popularity of the currencies, then eventually one becomes less popular than the other, and you get a breakout to either the upside if the dollar is the more popular one, or to the downside if the yen becomes the more popular one. That's how all of this works, and it's tied in together. It's all the system of finances, and markets and stuff like that. And us understanding that system allows us the ability to trade that system better. All right. Now that you got that, hopefully that makes sense and you understand it. I'm going to share two things with you real quick, and that'll be it. So first thing I'm going to share, let's see. I want to share this screen. All right. So this screen right here, this is a view. I'm just sharing, some views with you, a couple charts that I have view of, right, this is my view. This is what I'm looking at right now, right? I have three different screens with three different chart types that I'm seeing different things on. So this one, I'm utilizing the Lux Algo money flow profile. For this is one for me, this is, in my opinion, one of the better volume profiles, to utilize. Of course, there's quite a few out there, but this one for me, really works well, the visuals and stuff. And typically what I'm using it for is to give me that visual of, resting liquidity, right? Let me know at each price level what that resting liquidity looks like and the sentiment, right? So, the first thing that kind of stands out to me, and obviously verified by my demand, my zones, right? First thing that stands out, even without my zones here, is are the nodes, where we have high volume and high sentiment. So that tells me that these are key areas, right off the back. I already know that these are key zones right here. So, price is going to have a reaction to these zones, when it comes back. As you can see, price is consolidating right here. This is a key zone, right? It stands out from the rest. Now, the other thing that this also tells you is that once price breaks out of these key zones, that there's little volume, so price can move smoothly through those zones outside of the key zones because there's not a lot of volume, right? Or what have you, in its way to really stop it. So, price breaks through here, right? We got an opportunity to come down, and not really be bothered too much because there's not a lot of volume or a lot of interest or sentiment, right? So we know where the key zones are, with this indicator here. Again, I like the visuals and everything. Again, verified by, my zones, my supply and demand zones right here. Okay, that's all I wanted to show you with that one. All right, so that's the view with that particular screen. So I'll give you the view on my other screen. You saw my multi-time frame screen. So now I'm gonna share my other view with you, my technical analysis screen. This is my standalone. All right, so with this one right here, as you can see, very simple. This one, I have the view of the liquidity, or what have you, and what you're seeing right here is basically daily liquidity. So these red and green, this is all daily highs and lows, right? As you can see, like right here, this one coincides with this high and low, and it's like a cluster right here because these highs are kind of so close together, right? So then you got this high, right? That's right here. So technically, when price breaks this high, there's a really good chance it's going to go for this high. Then when it breaks that high, there's a good chance it's going to go for that high. So what you're looking for is how price reacts. So what I'm looking for is how price reacts when it gets to these liquidity zones. See, these are highs. These are daily highs right here that you're looking at, right? You can barely see it, and I got it that way for a reason. It's very faint. Those are 4 hour time frame highs and lows. Not really all that significant, which is why I have them really faint. But I have them on here because I did want to kind of see or what have you. And then you see my zones or what have you. And the green, that's just support. I wanted to make sure that, again, these are areas to possibly take buys from. These are areas to possibly take sales from. But again, it's also liquidity, right? That can fuel the market, in the current direction. The white lines are more so the weekly and the monthly highs and lows, weekly and monthly highs and lows, right? That's it. So that's what I wanted to share with you on this particular screen. So these are my three screens, the three views that I have. And then real quick, quickly I can change if I want to get an idea what's going on inside the candle. I can flip to my footprint right here. So again, this is a view that I may put up just to see exactly what's going on in the candle. And I like to I shared that on another video to show again I want to see what that liquidity looks like inside the candles or what have you. So there you go. There you go. There you go. Again, like I said, I hope this was informative. Like I said, somewhat insider type information about understanding the role that fair value gaps play in our trading, understanding that all fair value gaps aren't built the same. On the lower time frames, they're not as significant. Of course, the higher the time frame, the more significant the fair value gap. But also keeping in mind that price and the popularity and fundamentals is what drives it all. Coupled with the liquidity. All right. Thank you. And as always, good luck and happy trading.